What's up everyone, it's Austin Rutherford. Today, we're talking about a case study on a deal, and I'm curious, once we go over all these numbers, if this is a deal that you would have done. So once we get done, make sure you comment below. Let me know if yes, this is a deal that you would have done, or no, I'm crazy and you wouldn't have done this deal. And the funny thing is that when this deal first came across my table, I passed on it. I was like, nope. And then I thought about it for 24 hours and I was like, wait a minute, I need to do that deal. And I went back and ended up doing the deal. I'm gonna tell you why I said no at first and then why I said yes at a later moment. You can smash that like button, hit that subscribe and notification bell, it'd be greatly appreciated. So I got this deal from a wholesaler and they tried to assign it to me for $105,000. I reviewed the deal and I responded to them and I was like, hey, I'll do this deal, but I need it for $93,000. They said no, because it was $12,000 off, and I moved on to the next deal. The next day I woke up though, I was sitting there and I was like, well, what if I do this? Or I move this over here, I do that. All right, I'm in, let's do the deal. I'm gonna tell you exactly my thought process. So let's cut to my screen here and I'm gonna show you the exact numbers that I'm looking at when I made these decisions. So here are the numbers on this deal specifically, and I'm gonna talk about the entire deal and all the numbers behind it. So when I evaluated this deal, I thought that I could rent this property for $1,400 per month. So with that, my yearly taxes are $1,758, my yearly insurance is $725. I thought the after repaired value would be about $180,000. So there's two numbers that I look for when evaluating rental properties. One is that it cash flows at least $400 per month. If it was $400, this would be green, it's red, which means that it's less than $400 a month, but it's only like $7 less. So that wasn't a big deal for me, because at the end of the day, still a great deal as far as cash flow goes. So that wasn't the no for me. What the no was for me is that we look to use the BRRRR method, buy, renovate, rent, refinance, and repeat, into these deals using none of our own money. So we were going to buy this for $105, the reno was going to be about $40, and the holding costs were going to be about $7,200, which means all in, we're going to be all in for this deal for $152,000. When we take it to a bank to refinance out of this deal, the bank's only going to give us $144,000, which means that I'm going to have to put $8,000 of my own money into this deal on the refinance. And I didn't want to put $8,000 of my money into the deal, so I passed on the deal. So that's why this is red. If this was green, it means that we would be all in for less than what our new loan amount would be. So I passed on the deal because it didn't hit the numbers that I wanted it to hit. But what happened was I got a call from my CPA the next day and we were doing tax planning for the end of 2021. And what it boiled down to is I needed to have more write-offs. I needed to find ways of writing off more of my income so I didn't have a massive tax bill. One of the best ways to write off income to lower your taxes is by owning real estate and by claiming what's called depreciation. I have a ton of other videos on this, but depreciation is how you can lose money on paper but make money in real life to pay less in taxes. And yes, this is actually written into the tax code. So I look at it like this. So I look at this deal and I'm gonna be all into this thing for about $150,000. So my all in is the 152, right? So what happens is what I can do is called a cost segregation study. So I can do a cost seg study. Basically what that does is it speeds up the depreciation on a property. And I can usually claim roughly 25% of my all-in basis as a write-off on taxes. So 25% of $152,000 is $38,000. So if I'm paying taxes at a 40% tax bracket and a $38,000 write-off, how much money would that write-off save me on taxes? You take this and you multiply it by 40%. So instead of paying $15,000 to the government, I can do this deal and put $8,000 of my own money into this deal and own the deal. So basically my two options are to pay the government $15,000, or I can pay myself theoretically $8,000 and own this deal and make $400 a month for the rest of my life and have $28,000 of instant equity within this deal. So my question to you is, which one would you rather do? Would you rather pay the government $15,000 and get nothing for it? Or would you rather pay yourself $8,000 and own an asset of real estate and make $400 a month in cash flow and get the future appreciation, get the depreciation on tax write-offs, and get the tenant mortgage buy down? Which option would you want? I'm going with this option because this benefits me a lot more than writing a check to the government for $15,000. Always sat there and wondered how these like mega wealthy people never paid taxes. But once you learn the tax game, you start understanding how that happens. It's through what's called depreciation. You can take depreciation on real estate, you can take depreciation on heavy machinery, cars, vehicles, jets, airplanes, yachts, all these things you can take massive depreciation on. So that's how these people get around the system of not paying taxes. And again, these are all 100% legal. Like, I don't believe in paying zero taxes. Like, believe me, I'm still gonna pay a lot in taxes. I believe in using what's available to you to limit your exposure the legal way, which depreciation on real estate is a legal way to save money on taxes. Again, that's here in 2021, could change into the future, but as of today, it is written into the tax code and you can take those write-offs. So for me, it's a pretty simple decision, right? Like, buy more real estate, because I would rather own the asset. I would rather own real estate than having to pay the government the money and get basically nothing for it, right? So I'm curious what your thoughts are. Have you ever thought like this is a way to strategically tax plan, right? Comment below, let me know your thoughts. Let me know your questions or feedback on this strategy that I'm doing. And by the way, I'm going out and I'm buying a lot more properties here before the end of the year. Again, it's November 24th of 2021. And I'm trying to buy as many properties as possible so I can save money on my taxes, but own assets in real life. So drop a comment below. Let me know your thoughts. Let me know your questions. While you're down there, smash that like button for the YouTube algorithm. Hit that subscribe and notification bell. As always, appreciate you being here. See you on the next one.